Hello and welcome to a brand new edition of Inside Out on the Road, a show where we focus on individual stocks with in-depth analysis, deep dive into financials, and also tell you about the key risks and triggers going forward. But let's not waste any time and get to our first stock today. My colleague Sonal traveled to Dahej in Gujarat and gets us this very special deep dive into Navin Fluorine.
We are here at the Dahej Chemical Complex and specifically at the manufacturing facility of Navin Fluorine, which is a very well-known name in the stock market. It is one of the largest domestic manufacturer of fluorochemicals in the country and has three segments. CDMO, which is around 20% revenues, there is high performance products, and there is also specialty chemicals. Now, where are these chemicals used? Across industries, be it agrochemicals, pharmaceuticals, electronics, dyeing, textiles, you name it, and the company actually caters to those segments as well. Now, if we talk about what the financial performance of the company has really been, they did revenues of close to 1400 crore rupees in FY22, and in terms of margins, from the levels of 22%, they have been able to scale them up between 24 to 25% in the last couple of years. Their profits, after falling from levels of 400 crore rupees in FY21, have stabilized around that 260 crore mark. Now, this is about the financial performance. There are a couple of triggers for the company as well. They are getting into the fourth segment, that is electronics materials manufacturing, and this is where they expect significant revenues to come in from. Capital allocation for this particular segment is expected from 2024, and it will be catering to energy storage, solar, semiconductor, to name a few. The second one is their big project or the big contract that they'll won from Honeywell, which got commercialized in Q1 of FY23, and the capex here was around 400 crore rupees. It's a $410 million project that they won here, and it was commissioned recently, as I said. In terms of capex, they have big expansion plans in place. Around 1700 to 1800 crore rupees is something that they announced over calendar year 24 to 25, and more than 1800 crore rupees for years to come by after that. The stock, not very cheap, trading at 48 times FY24 earnings. But to know more about the company, we'll just get in the management and tell you all about it. As promised, we are here at the Dahej factory of Navin Fluorine, and we have with us none other than Mr. Welling, who is the MD of the company, joining us to explain all about the business and take a deep dive into the company as well. Sir, thanks a lot for joining us. It's a pleasure to have you with us. You've been on an expansion spree, on a capex spree as well. What are your plans here? And this is a new facility that I'm looking at.
Yeah, so first of all, welcome to Navin Fluorine, to the Dahej site, and thank you very much for being here. As you know, in Navin Fluorine, we have three business verticals. The first one is CDMO, where we work with the global innovators. Now, the products which we supply for that particular business is made out of our CGMP facility near Indore. Whereas this facility will be actually supplying products to the other two verticals, which is specialty, where we deal with agrochemicals and performance material, and the high performance product. So here right now, you're actually seeing these two plants, which are already commissioned, and the production is going on in full-fledged manner. These are two plants which is manufacturing products for Honeywell, whereas we have these two plants which are for specialty. This is the plant which is dedicated for agrochemicals, and this is the multi-purpose plant. Both these plants have just been commissioned, and the trials are currently, phase-wise trials are currently going on. If you look at this entire site, is about 76 acres, and these are the first set of plants which have come in. We also have the board approval now for another large plant. The plant is going to be ready by end of next year, and by doing that, approximately about 25 to 30% of the space will get occupied. We still have enough room for expansion, and over the next few months and years, you'll actually hear more announcements for expansion, which will basically be coming at this site.
So exciting times ahead for Navin Fluorine. In that case, recently on the conference call, you already announced the capex of say 1800 crore rupees. Is there, when you say there is more expansion to come in, are you ready to put in same amount or maybe double the amount of what I just said? And what kind of potential are we looking at here, especially from the newer plants that just came in?
As far as the capexes which I have already announced, we have already given out the numbers in terms of what the expected asset turn, etc. is. Now, in terms of the future capex number, so we typically don't have a target number as such, but what we are doing is currently we are working on projects under each of the three verticals. In CDMO, we have talked about CGMP4, which obviously will be coming up in Devas, and under HPP as well as in specialty, we are working on a number of projects. As we are ready with it, we'll be going to the board for specific approval, and at that point in time we make the announcement. Apart from that, we will also be making an announcement in a large hydrofluoric acid capacity, which will be the basic raw materials feeding into all of these. Till such point, hydrofluoric acid will be supplied from our Surat facility, which is not very far from here.
Okay, so a lot of expansions in place. I'll come back to you on the numbers in specific in a bit. Let's go segment-wise for you. We started with the CDMO thing first. It's 20% of your revenues, usually higher gross margin business. Do you plan to scale it up further? Can you tell us what kind of contracts are here in place? Is it a longer term contract? Is the pricing here better? And in future, out of the three verticals, what would the priority be?
As far as CDMO is concerned, we are currently working on CGMP4, which will be the next GMP facility, which will be a much larger facility than all our three previous facilities. But on the business side, we are actually seeing a lot of traction from our existing customers as well as new customers. Apart from what happened in COVID, as you know, it typically takes about 8 years for the molecules to start commercializing. And this business was actually started by us in 2011, 2012. So a lot of molecules that we've been working on for the last 10 years are now reaching very interesting phase where they all will get commissioned, and hence CGMP4, which will be significantly larger capacity plant than our earlier plant. At Devas, we also have room for 2 more additional GMP plants post CGMP4, and I hope that as these molecules progress, we will be working on these additional capex opportunities.
Okay, so now since you have so many expansion plans in place, this year a lot of processes have come on stream as well. 1,500 crore last year, will you be able to do a 50% growth this year, assuming 2,000 crore rupees this year? And consecutively, do you think 4 to 5 years down the line, you will be able to scale these revenues up? Say, you will be able to do around $1 billion.
So last year we did 1,400 crore,
Right.
1,400 crore is what we did last year. This year, with the way the things are going, we believe we should be close to 2,000 crore or might just exceed 2,000 crore. Without getting into the specific numbers, year-to-year numbers, our focus is to ensure that we double the business every 4 years plus minus. Our internal hope would be that every 3 to 4 years we actually double the business. And that is what we are actually working on currently. If you actually look at the capex announcements that we have made, it's very easy to extrapolate the numbers through, let's say, FY25, FY26. But beyond that also, we believe that even on a higher base, we will actually be able to continue at the same growth trajectory in terms of percentage.
Okay, so I'm holding on you to that 35% growth rate over and above the 50% growth rate that you might see. Of course, these are the estimates
Again,
that we are working
these
with.
growth rates that we are talking about, given what is happening globally, sometimes might not be linear.
Yes.
So it's not that every year we will grow exactly by that same percentage, but directionally, yes, that is what our intent would be.
Okay, interesting. So let's get more specific now, because I wanted to understand the supply chain for your business, because everyone thinks that all chemical companies are the same, but that's not the case. For you especially, the raw materials like fluorspar, you're talking about the HF facility coming up, how much are you dependent on external suppliers for raw materials, and how much are you dependent on imports for your raw materials?
So currently, our focus clearly is to ensure that all the critical building blocks required for all our projects are manufactured by us ourselves. Now, for raw materials of those building blocks, we might have to depend on some other companies. But most of for example, the Honeywell project that we talked about, all the raw materials, critical raw materials, come within the vicinity of 10 kilometers, radius of 10 kilometers. And that is what our focus is, to ensure not only the raw materials are from India, but also are from the vicinity, because that is what a lot of our customers are really focusing on, not just from the point of view of supplier resilience, but also from the point of view of carbon footprint. So that is extremely important for us. Of course, hydrofluoric acid is the most important raw material which we produce ourselves. As far as our fluorspar is concerned, most of it currently comes from South Africa. And to your question specifically related to raw materials coming in from China, we have very negligible dependence on China at this point in time.
So your underlying demand comes from agrochemicals, pharmaceuticals. How are you able to protect the company from, say, the cycles that we see in these industries? And how do pricing scenario work here? Is it like a long-term contract that you have with your customers? Because things changed a lot after COVID, right? So were you able to raise prices, or is it a very volatile environment when it comes to pricing for your products?
Yeah, so there are two questions you talked about. If you look at our business model, we have completely focused on fluorination. That's our core value proposition. But within that focus, our business model is extremely diverse. So we supply to almost 8 industries, from agrochemicals to pharma to petrochemicals, etc. And what we have typically seen is some of these industries actually don't see the cycle, like healthcare and hence pharmaceutical. Some of them tend to be cyclical, like agrochemicals, but we have other sectors. So typically, if you look at our past, you will actually see that there will be quarters when one business does extremely well, whereas other business doesn't do as well. So we have that counterbalance existing within our portfolio. As far as the contracts are concerned, many of the contracts that we have are on a cost plus basis. So we have all the cost, and we tend to be extremely transparent with our customers in terms of what those costs are, and we ensure that our margins are safeguarded. It's all on a cost plus basis. Wherever it is not, we have been very, very fortunate to have excellent set of partners that we work with. So wherever we actually start seeing the heat because of the raw materials, etc., we engage with our partners, and by and large what we have seen is that our partners really support us. So for example, there is one particular partner that we have been working with for last 20 years, and the contract that was done with them talked about 5 years fixed price, because this was done in an era where there was absolutely no volatility. And when we saw this volatility, we actually went back to the customer, and within 1 year, we actually changed the price 4 times. And they were extremely supportive because they understood where we were coming from.
Okay. So that is about your existing 3 segments. You're getting into a new exciting segment as well, electronics, right? So that is one segment where you will be providing chemicals for, or your chemistry for. What made you, focus on this one? What is the opportunity here, and what kind of potential do you see here?
If you actually look at some of the larger trends that we are seeing, either in terms of the electrification or in terms of solar, etc., or you actually look at electric vehicles, etc., you actually see that fluorine molecule plays a very important role in each of these. And we want to be where the fluorine molecule is. So that's one part. The second is actually, if you look at our story till now, we've pretty much been manufacturing in India for the world. Whereas we are now seeing a lot of opportunities where you can actually focus on make in India for India. We've actually identified these 3 set of opportunities, and we believe that this is very, very early stage. The ecosystem in India will probably start developing only in a meaningful manner, only from, let's say, 2025, 2026 onwards, when the revenue coming from these initiatives will actually contribute in a very, very meaningful manner to our overall contribution. So the next 3 years at least, we believe the growth will primarily come from these 3 existing segments, and post that we will see growth happening from these segments and also from electronic material division. But we believe that from 27 onwards, at least that's our hope, that we will actually start seeing some kind of a hockey stick effect in that. What that number would be, it's very difficult to predict, because we actually play really upstream. And for us to be able to supply our molecules, that entire ecosystem has to get developed. So a lot of it will depend on the PLI schemes, the success of PLI scheme, the success of the investments coming into India, etc.
Okay. So interesting, you speak about make in India for abroad right now, but you are shifting that as well to make in India for India. A lot of volatility is what we've been talking about. Global scenario in the industry has changed. Everyone's been talking about Europe +1 now after China +1. What is your take as a person who's been in the industry for so long? Do you think it is for the longer term benefit for the country, for the industry, or is it something that we'll have to see and it'll be a wait and watch situation?
So personally and for our company, we actually typically don't believe in all these plus one theories, China plus one, Europe plus one, etc. Our belief is that our focus has to be on becoming the one rather than plus one. I believe that there will be some short to mid-term opportunities based on what we are seeing in China or what we are seeing in Europe. But I don't believe you can really develop a mid to long-term strategy on the basis of this opportunistic model.
So since you are talking about getting growth profitably and looking at increasing margins, last couple of years, margins have been around 24 to 26% for the company. Say when you're talking about that hockey stick growth by 27, will margins also grow at a similar pace? And also segment-wise, CDMO usually tends to have higher gross margins. At the operating level, are all these three businesses also like that? What is the margin outlook, say 2 to 3 years down the line?
Yeah, so first of all, as far as the hockey stick effect, I was primarily talking about the electronic material division, and that was not by but from 27 onwards. But as far as that division is concerned, it's very difficult to predict what's going to happen in the future in terms of margins, etc. But you're right in saying that over the last few years, we've actually moved from about 21-22% to about 25% plus minus. All the new projects that we are working on are planned for margins which are higher than our base margin, which is higher than 25%. And as these plants commission and actually start operating to the full capacity, our overall margin profile will start improving and will actually start moving towards 30% depending on how well we are able to scale up the molecules in each of these plants. And that has been the focus, when we are working on each of the new projects, our focus is to ensure that all these new projects need to help us improve our overall margin profile, and hence, as I mentioned earlier, it's not growth for the sake of growth, that is profitable and sustainable growth.
So last question before we let go of this interesting conversation, the CapEx plans that you have in place, what are the funding plans here? Will you be raising debt? Will it be tapping markets for equity raising as well?
So as you know, we have basically been a debt-free company all along. Now to be able to fund these projects which we have already got approval from the board on, we have taken a debt of approximately about 500 crore. We currently have no plan for equity raise, and we also expect that as these molecules and as these plants scale up and start working at full capacity, we are confident that we will be able to generate strong enough cash flow to start supporting the newer CapExes that we have planned for. But as we actually work on some of these larger future CapExes and take them to the board, if at that point in time, if we decide to take additional debt, or at that point in time, if we decide to raise equity, etc., that point in time we'll come back and report on that. But currently there is no plan for any equity raise.
All right, okay. So Mr. Welling, it was a pleasure speaking with you. Thank you so much for joining us on Inside Out.
All right, that was a deep dive into Navin Fluorine. But time to slip into a short break. We'll come back with another interesting stock. Piramal Pharma is the stock we're focusing on our Swotlight segment on the other side. Welcome back to Inside Out. Well, let's focus on our Swotlight segment. Piramal Pharma is a stock on our radar, and the raging debate is whether there's value or it's a trap. Well, the company listed in October 2022, and it's a demerged pharma arm of Piramal Enterprises. The key reason for demerger was simplification of the corporate structure. But since listing, well, the stock has pulled back close to around 30%. And the market capitalization is around 16,000 crores, which is a far cry away from what it listed at. And it's even low at the valuations at which Carlyle picked up 20% stake a few years ago. Well, the company has three broad divisions. It includes CDMO, that's the largest part of their business, followed by complex hospital generic segment, and finally, India consumer healthcare business, which is growing at a fast clip. Now, going by these three verticals, the company can be categorized as a non-commoditized player. Let us tell you a little bit more about each division, starting with CDMO. Well, the company has 13 sites across North America, Europe, and India. It boasts of capabilities across drug substance and drug products. They claim to be in the top 3 in India and have global footprint with capabilities to meet wide range of customer requirement. The company has been leveraging their end-to-end model to offer integrated services. They're also focusing on deep development project pipeline and growth-oriented capex to drive growth. Next up, let's focus on the complex hospital generic segment, which has focus on inhalation anesthesia and pain management, as well as other injectables, and the company claims to be the fourth largest inhaled anesthesia player globally. The company says that strong inhalation anesthesia sales in the United States with volume growth is driving market share gains. They're witnessing robust demand from markets like Japan, South Africa, and LATAM. Well, the smallest part of their business is India consumer healthcare, but it's growing at a rapid pace. This segment houses brands like Lactocalamine, iPill, Saradon, Littles, and Polycrol. The company claims to be ranked 10th in the OTC segment in India. They have been reinvesting the profits back into business and so consciously working at EBITDA neutral as they are spending more on sales promotion so that they can grow the top line faster. The management says that when this segment hits around 1,000 crores, they believe it will be able to cover the fixed and the variable costs, which in turn will aid profitability. Now, in the second quarter, well, they grew in only single digits and margins were in low teens. The street was clearly disappointed. However, the second half of the year has been much stronger than the first half, with around 55% of revenues and 66% of EBITDA being reported in the second half. The company guided that this trend is likely to continue in this year as well. They've also guided for a meaningful improvement in EBITDA margins with improved traction in sales. The net debt is around 4,400 crores, and that's gone up in the last 6 months or so. So the total enterprise value is around 20,000 crores. Then the management has said they expect 15% revenue growth in the next 3 to around 5 years, and they've reiterated that margins will scale towards mid-20s. So in FY25, if the revenues can hit around 10,000 crores and EBITDA could hit around 2,500 crores. Now, on a valuation front, the stock is trading much cheaper than its peers and it enjoys valuation comfort, though some of them may not be directly comparable. But delivery of the guidance that the management has given is extremely crucial, and the street appears to be a little bit cautious on them falling short. Well, we have run out of time on this edition of Inside Out. It's goodbye from Sonal and myself. But you do keep writing to us and tell us about companies you want us to discuss, and we'll try to feature them on the show. Thanks so much for watching.